Stop what you're doing for a second because the silver market just crossed a line that almost nobody was prepared for, and the consequences of that move are only starting to ripple through the system. I'm not talking about a cute breakout or a headline-friendly spike that fades once the cameras turn away. I'm talking about the psychological 100 level getting obliterated and price not hesitating, not pausing, not politely checking back to see if anyone's comfortable with it, but moving with urgency, like something underneath the market just snapped. And if you think this is just another hype-driven surge that cools off in a week, I need you to slow down and listen carefully, because the real story isn't the number on the screen. The real story is who's trapped, who's scrambling, and why this move has all the fingerprints of the opening act of a much larger repricing that most people won't recognize until it's already too far gone. I want to timestamp this moment so there's no hindsight bias later. It's Thursday, January 29th, 10:39 in the morning, New York time, not after the dust settles, not weeks from now when narratives have been polished and blame has been assigned. Right now, while the market is still processing what just happened. And here's why that matters. When markets shift regimes, they don't send invitations. They don't ring a bell and say, "This is the part where you should rethink your assumptions." They move fast, they create confusion, and they punish anyone who treats a structural change like a temporary anomaly. For a long time, the conversation around silver was stale. You've heard it 1,000 times. It's manipulated, it's dead money, it never moves, it disappoints everyone. The mining stocks are a graveyard. That narrative didn't just exist, it hardened. It became muscle memory. And that's exactly why this move matters so much. Because when an asset spends decades training people not to believe in it, the eventual breakout doesn't need universal excitement to keep going. It feeds on disbelief, it feeds on hesitation, it feeds on people saying, "This can't be real," while the price keeps climbing anyway. You can feel the shift if you're paying attention. The questions people ask have changed. It's no longer, "Should I maybe buy a little silver someday?" It's, "How did I miss this?" It's not curiosity anymore. It's regret mixed with urgency. And that emotional pivot is important because it often marks the transition between the early phase of a bull market and the phase where participation starts broadening. Not mania, not euphoria, just the slow, uncomfortable realization that the old framework no longer works. So let me be very clear about what I'm going to do here. By the time this is over, you're going to understand why the move to 100 wasn't the destination, it was the invitation. Why the difference between the paper price and the street price matters more now than it did at any point in the last decade. And why the next phase of this story is likely to emerge in places most people aren't watching yet. Inside supply chains, inside regional price disparities, and inside the stocks that still look boring precisely because the market hasn't caught up. And I know what some of you are already thinking. It hit 100. I'm late. That sentence feels logical, but it's almost always an emotional defense mechanism, not an analytical conclusion. People said the same thing about gold at 2,000, about oil at triple digits, about entire sectors right before they doubled again. I'm not saying price can't pull back. Of course it can. I'm saying that too late is usually what the brain says when uncertainty shows up, not what the math says when a long-term range finally breaks. Here's a reality check most people skip. Silver being stuck for decades created a generation of skeptics. That skepticism didn't disappear when price moved. It's still there, and that's exactly why the rally has fuel. Bull markets don't need everyone on board at the start. They need resistance. They need disbelief. They need people selling too early and promising themselves they'll buy it back lower. That's how momentum builds without looking like a bubble. Now let's clear up something important. Excitement in the room is not the same thing as a top. Real blow-off tops come with absurd leverage, massive inflows from people who've never cared before, and a sense that risk no longer exists. From what the data shows right now, we're not there. Interest is rising, but it's not manic. Positioning is heavy in places, but it's not universally reckless. That's why this phase is so dangerous for people trying to trade it like a short-term flip. The market can keep grinding higher while you wait for the responsible pullback, and then suddenly you're chasing a price you swore you'd never pay. So yes, we need to talk about short covering, but we also need to talk about something bigger: structural demand, fragile inventories, a market that's small enough that relatively modest reallocations can cause outsized moves. This isn't just about traders hitting buttons, it's about pressure building across multiple layers at the same time. Here's the simplest version of the spark. When a market has a meaningful number of participants positioned the wrong way and price starts moving against them, the environment changes instantly. It stops being a calm negotiation and turns into a forced process. That's what a squeeze really is. Not enthusiasm, obligation. Buying that doesn't care about valuation, doesn't care about charts, and definitely doesn't care about whether a level looks overextended. It just needs to get out. But here's where people oversimplify and get fooled. They want one story. It's all a squeeze, or it's all fundamentals, or it's all manipulation. Real markets don't move that cleanly. You can have a squeeze happening while macro forces are pushing capital into hard assets. You can have tight physical supply while paper leverage sloshes around on top. And when those forces collide, price action starts to look unhinged. That doesn't mean the market is broken. It means it's under stress. Let me explain what a squeeze actually feels like in human terms. Imagine you sold something you don't own, expecting to buy it back cheaper later. As long as the price drifts down or sideways, you feel smart. But when it rises, the math turns on you fast. Losses compound. Margin requirements tighten. Someone eventually tells you to add cash or close the position. If you can't add cash, you're forced to buy. That buying pushes price higher, which forces more people into the same corner. And when that process hits a small market, it doesn't creep. It lunges. Silver is not a massive market. It doesn't take a tidal wave of capital to overwhelm it. That's why it can look dormant for years and then suddenly move like it's possessed. People forget that until it reminds them. Now add history to that setup. Silver has lived under a psychological ceiling for generations. Every rally was sold, every breakout faded. That history anchors expectations. And when a multi-decade ceiling finally gives way, the move isn't just about price discovery, it's about belief discovery. The market is relearning what silver is allowed to do. That process is rarely smooth. And here's the part most people get wrong. A violent move does not automatically mean the end. In commodities, it can just as easily mark the beginning of repricing, especially when the prior range lasted longer than most participants have been alive. Now let's talk about the uncomfortable part, the one people whisper about but don't like to confront. For years, a large portion of the silver market has been built on promises, paper claims, exposure without possession. And in calm markets, that structure works because nobody asks for the thing itself. But when price starts running, behavior changes. People start asking for delivery, they start wanting metal, not just exposure, and that's when the system gets tested. Think of a crowded building. The issue isn't the chairs, it's the exits. A squeeze reveals whether the exits are wide enough when everyone moves at once. That's where we are right now. Not at a conclusion, but at a test. So when people ask, is this the moment silver gets a new normal price? The honest answer is maybe. But floors aren't declared by numbers. They're earned by time and behavior. You don't need to guess where the floor is. You watch the signals. Do premiums stay elevated even when price cools? Do delivery times stretch instead of shrink? Do buyers step in aggressively on dips? Those clues tell you far more than any headline. And here's the sneaky part. The strongest bull markets often feel weakest right after the first major breakout. They frustrate everyone. Bulls feel uneasy. Bears feel vindicated on pullbacks. That frustration phase is often where the next leg is built, quietly, while attention shifts elsewhere. Now ask yourself a more useful question. What would it take for the old pricing system to regain control? Because what makes this moment feel different isn't just the price, it's the behavior around it. The time of day moves happen, the regional premiums, the way physical demand refuses to wait for paper markets to give permission. And that's where this story gets even more interesting. And this is where you have to stop thinking about silver as a single global price and start thinking about it as a system under tension. Because one of the quiet signals that tells you a market is changing regime is when different regions start pulling on price in different directions. Over the last stretches of this move, something subtle but important has been happening. More and more of the decisive price action has been occurring during Asian trading hours, not just during the traditional Western sessions. That alone doesn't prove anything. But when you combine it with persistent reports of physical premiums in parts of Asia versus New York pricing, it starts to tell a story. There have been moments where silver priced in Shanghai has carried a noticeable premium relative to New York. Not a theoretical arbitrage blip that disappears in seconds, but a real, persistent gap that reflects local demand meeting limited supply. Sometimes that premium drifts into the high single digits. At times it flirts with low double digits. That does not mean the Western price mechanism has vanished, but it does mean something critical. Physical demand is strong enough in certain regions that it is no longer politely waiting for the futures market to adjust. And when that happens, the futures market eventually has to respond, not because it wants to, but because it loses relevance if it doesn't. People love to talk about arbitrage like it's frictionless, like metal can just teleport across oceans to close any gap. That's a fantasy. Metal's arbitrage is physical. It involves bars that meet specific purity standards, logistics, shipping capacity, insurance, regulatory rules, delivery windows, and inventory availability. When supply chains are tight, those frictions matter. That's why price gaps can persist far longer than textbooks suggest. And every day they persist, pressure builds. Now here's the cliffhanger embedded in that. If those regional premiums hold, they act like magnets. They pull physical metal toward where it's valued more highly. And when that happens, inventories elsewhere tighten. The paper market can ignore that for a while, but not forever. At some point, the stress leaks upward and shows up in volatility, in delivery rules, in margin changes, or in sudden price surges that seem to come out of nowhere. This is also why simply saying it hit 100, take profits and walk away is an incomplete thought. Taking profits into strength can be rational, but selling because a number feels scary is not a strategy, it's an emotional reflex. Milestones don't just repel price. They attract attention, they attract momentum, they attract participants who were waiting for confirmation that something real is happening. And in a squeeze-like environment, milestones can become launching pads rather than ceilings. What I'm seeing right now is not a market that looks exhausted. It's a market that looks contested, and contested markets don't resolve in one clean move. They resolve in waves, sharp rallies, unsettling pullbacks, then higher highs that force people back in at worse prices. That's how conviction gets transferred from early holders to latecomers. Now let me address something that gets thrown around carelessly: the idea that manipulation is over. That's not how I see it. What I see is the cost of control rising. Suppressing price in a market with growing physical tightness and forced buying becomes more expensive over time. The tactics don't disappear, they just lose efficiency. And that distinction matters because when the cost of maintaining an illusion exceeds the benefit, the system doesn't collapse gracefully, it slips. Another sign this isn't a one-week wonder is the scale of outstanding positions. Futures markets often carry open interest that looks enormous relative to the amount of metal that's easily deliverable. The key isn't a single data print, it's persistence. When heavy positioning remains even after a breakout, the unwind doesn't happen in a day. It happens in messy stages: covering, reloading, hedging, panicking. That's why price action can feel erratic even as the broader trend remains intact. Now let's peel back another layer, because focusing only on positioning misses a second engine that's been quietly running for years: industrial demand. Silver is not just a monetary metal, it's a critical input in a world that's electrifying everything. Solar panels, power grids, electronics, data centers, vehicles. Silver sits inside more of that infrastructure than most people realize. Recent industry data has shown industrial silver demand pushing toward record territory, with total industrial usage hovering around the 700 million ounce range in recent years, driven largely by solar and electrification. And here's why that matters. When industrial demand is strong, it doesn't disappear overnight just because price rises. Companies don't redesign entire production processes on a whim. Substitution happens slowly and unevenly. It requires confidence that higher prices are permanent, not temporary noise. Even within solar, where efficiency gains have reduced silver loadings per panel, total demand can still rise if installations grow fast enough. Fewer grams per unit doesn't matter if the number of units explodes. That's how markets stay tight even as technology evolves. And this leads to a critical structural point. The silver market has been flirting with deficits for years. Demand has frequently exceeded supply, making inventories the buffer. When inventories matter, price becomes sensitive. Small surprises have big effects. According to recent projections, global silver supply sits a little over 1 billion ounces, with mine output in the mid-800s of millions. And despite that, forecasts still show meaningful deficits. That's not a setup that resolves cleanly. Now here's something most people don't internalize. A large portion of silver production is a byproduct of mining for other metals like copper, lead, zinc, and gold. That means silver supply doesn't respond directly to silver prices. If base metal mines slow down or shut due to unrelated economics, silver supply can drop even if silver prices are high. That's why the supply response is often weaker than people expect. And this brings us to the silver stocks, the part of the story that hasn't fully woken up yet. In theory, miners should be leveraged plays on the metal. Rising prices should expand margins faster than costs. That's the textbook. But reality is messy. Investors have been burned before. Dilution, cost overruns, political risk, taxes, operational surprises. So capital is cautious. But here's the pattern that repeats across cycles. Stocks lag. Then a few companies report strong earnings. Analysts revise numbers. Institutions re-rate the sector. And suddenly the lag vanishes in a handful of violent sessions. By the time the narrative flips, the easy entries are gone. If you're looking at miners and saying this rally must be fake because stocks haven't exploded yet, you might be mistaking lag for denial. Markets often wait for proof before repricing equities. That proof usually arrives after the metal has already moved. Now let's zoom out, because silver doesn't move in isolation. Gold is the anchor. Gold reflects trust, or the erosion of it. When gold rises, it's not just commodity traders, it's macro hedgers, it's institutions protecting purchasing power. And gold doesn't need universal participation, it only needs a small fraction of large portfolios to shift a small fraction of their assets. That alone is enough to overwhelm available supply. And here's the uncomfortable truth. The world feels less stable than it did a decade ago. Markets price stability. When stability erodes, demand for insurance rises. Gold is insurance. Silver is insurance with an accelerator attached. That combination is volatile by nature. I don't need a dramatic reset story to explain this. High debt levels, persistent deficits, currency competition, and the reality that real yields can slip negative again if inflation stays sticky while policy becomes constrained. That's enough. The most important part of monetary transitions is not the announcement, it's the drift, the slow erosion of confidence before the headline arrives. And you can see that drift in one behavior that rarely makes headlines. Countries wanting their gold closer to home. Repatriation isn't panic, it's preference. It's about control. And when control becomes a priority, it tells you something about trust. We're also entering a period where resources are no longer just economic inputs, they're strategic assets. Governments are waking up to the reality that electrification, defense, and technological dominance all depend on secure access to metals. And securing access takes time. Decades, not quarters. That's why supply chain reshoring and critical mineral strategies keep colliding with reality. You can't shortcut geology. Now bring this back to mindset, because this is where most people lose. Investors are trained to think in days and weeks. Commodities don't reward that. They reward people who understand cycles. If you're asking what to do tomorrow, you're missing the point. The better question is what this looks like over the next several years if these pressures don't ease. Population growth, power demand, AI infrastructure, grid upgrades, defense spending, supply chain realignment, currency skepticism. These are not fleeting stories. These are multi-year forces. And when multi-year forces meet a small market, the market doesn't negotiate. It reprices. That's why the smartest approach isn't betting everything on one outcome. It's building exposure in layers. Liquid exposure for flexibility, higher risk exposure for upside, and patience for volatility. Because the next pullback will feel ugly. It always does. That's how bull markets test conviction. Being early feels the same as being wrong, right up until the moment it doesn't. And this is where most people make the fatal mistake of thinking the hard part is over. They see the breakout, they see the headlines, they see the volatility, and they assume the story has already played out. But in reality, this is usually the phase where conviction gets tested the hardest, not rewarded the fastest. Because what comes next is rarely a straight line. Silver doesn't need to go straight up from here to validate what just happened. In fact, the most powerful moves often come after the market does something that feels wrong. A sharp rally, followed by a messy consolidation. Sudden drops that feel like failure, followed by violent recoveries that leave late sellers staring at their screens in disbelief. This is how pressure is redistributed. This is how ownership transfers from impatient hands to patient ones. And here's the part most people don't want to hear. If this really is a structural repricing and not just a tactical squeeze, the volatility is going to get worse, not better. Bigger up days, bigger down days, wider ranges, louder narratives. That's not a bug, that's the mechanism. Markets don't move everyone together, they move people out. Now let's zoom back to the question everyone keeps asking in one form or another. Is this sustainable? The honest answer is it depends on behavior more than price. Watch what happens on pullbacks. Do buyers step in aggressively, or do they disappear? Do physical premiums collapse the moment price cools, or do they stay stubbornly high? Do delivery timelines normalize, or do they stretch further? Those answers will tell you far more than any single candle on a chart, because price alone can lie. Behavior doesn't. And here's another subtle signal. Pay attention to where conversations are happening. Early in a cycle, the discussion lives in small corners, specialists, niche forums, quiet accumulation. Later, it spills into mainstream finance, then finally into dinner table talk. We're not at that last stage, not even close, which means the market still has room to frustrate people before it satisfies them. This is also where people misread the role of silver stocks. If you're expecting miners to immediately explode higher just because the metal moved, you're applying equity logic to a commodity cycle. Stocks lag until cash flow shows up. Then they move faster than anyone expects. That delay is not a sign of weakness. It's a sign the market hasn't priced the new environment yet. And when it does, it won't do it politely. Now let's talk about the supply response myth one last time, because it keeps resurfacing. Higher prices do not magically create more silver next year. Mining is slow. Permitting is slower. Development timelines are measured in decades, not quarters. In some regions, new mines can take 20 years or more from discovery to production. And even when new projects come online, they often replace declining output elsewhere rather than adding net supply, which means the buffer stays thin. And when buffers are thin, surprises matter. Now layer on geopolitics, because ignoring it is no longer an option. Metals are becoming strategic. Countries are thinking in terms of security of supply, not just cost. That changes incentives. It changes stockpiling behavior. It changes how aggressively buyers step in during periods of stress. And once governments start viewing metals as strategic inputs rather than just commodities, price elasticity changes. Silver sits in a unique position here. It's small enough to move dramatically, important enough to matter industrially, and liquid enough to attract financial capital when trust in currencies wobbles. That's a dangerous combination for anyone positioned the wrong way. Which brings us back to the original question. Why does this move feel different? Because it's not just about price discovery anymore. It's about trust discovery. Trust in pricing mechanisms, trust in supply chains, trust in the idea that paper claims and physical reality will always stay aligned. History says they don't. Every major commodity repricing looks obvious in hindsight and uncomfortable in real time. People always say they would have bought earlier, held longer, stayed calmer. But when you're actually inside the move, it feels messy, confusing, emotionally exhausting. That's normal. The real risk isn't volatility. The real risk is misinterpreting volatility as a signal that nothing has changed. Sometimes volatility is the signal. So instead of asking, "Is this the top?" ask a better question. What would convince you that this move is more than noise? And what evidence would actually change your mind if it appeared? If you can't answer those questions, you're reacting, not thinking. And here's the final cliffhanger I want to leave you with. The silver market, like all small critical markets, runs on an assumption that not everyone will demand the real thing at the same time. That assumption holds until it doesn't, and when it doesn't break gently. The price you see on the screen is only part of the story. The real story is whether the system can deliver at that price when demand refuses to wait. So watch the behavior, watch the premiums, watch the inventories, watch who keeps buying when the market tries to shake them out. Because if this is the beginning of a lasting repricing, the loudest move won't be the one that gets your attention. It will be the one that happens while everyone is still arguing about whether the last move mattered. And by the time the argument is settled, the range everyone anchored to will already be gone. That's how these shifts happen, quietly, then suddenly. And if you're paying attention, you won't need permission to recognize it.